Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at 4 of the safest dividend paying companies on the market right now. These stocks have proven that over the long term, through every recession and depression, not only can they continue to generate profits and cash flow, they can return a growing dividend to their shareholders year after year. And in this video, we're going to take a look at 4 boring companies who provide growing passive income every single year, and these are considered some of the safest dividend companies you can buy on the market. And when you're buying dividend income, you're collecting passive quarterly cash flow into your brokerage. And dividends, I believe to be one of the purest forms of passive income. After you make your initial investment, you watch that cash flow come in without doing any other work. And in this episode, we're going to take a look at 4 dividend companies who have proven they can continue to generate growing cash flow through some of the toughest times our economies have ever seen. And we are expecting that for long into the future, these companies will continue to generate that income and pass it on to their shareholders year after year. And before we take a look at that first stock, I'm going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos. And now we're going to jump into the first boring company that pays out a safe and growing dividend, and that is ticker PG. Procter Gamble, the company currently trades for $134 per share, and they're up by over 13% on the 1-year chart. They're one of the strongest, most diversified, and most brand recognized consumer companies in the world, with the current market cap at $330 billion, and they're trading with a forward PE ratio right around 24.1. And for a dividend company, the current yield comes in at 2.56%. And if you're unaware, Procter Gamble sells consumer goods across 10 different categories, which include home care, oral care, family care, hair care, and many more. And this company sells pure necessities. They provide the goods that consumers will continuously need to buy through any good or bad economic period. And Procter Gamble is a company that does a great job of returning capital to their shareholders. Back in fiscal 19, they returned a total of $12.5 billion to their investors in the form of share buybacks and a quarterly dividend. Fast forward through fiscal 2021, they're forecasting a total of $19 billion of capital brought back to their investors, $8 billion in the form of the dividend, and $11 billion in share buybacks. And over the past decade, they've returned $125 plus billion to their shareholder group, which is absolutely phenomenal. And of course, why you're watching this video is for the growing dividend income. And we can see that Procter & Gamble has been growing that payment for 65 consecutive years, and their latest increase was a 10% raise back in April 2021. And in total, this company's been paying out a dividend for 131 years. So going back to the late 1800s, Procter & Gamble has been paying out that quarterly cash flow. And taking a look, even for a well-established company, they continue to expand slowly year after year. $65 billion of total revenue, up to 66, 67, 70, and now over $74.8 billion of total sales in the trailing 12 months. So even for a large cap company, they continue to expand their business every single year, which is a very strong sign. And if we take a look at their dividend scorecard, the current yield comes in at 2.5%. Their payout ratio is at a very sustainable 62% of their net income, and their 5-year dividend CAGR is at 4% per year. So your annual dividend increase is slightly outpacing inflation each and every year as well. And why they're included in this video is because they have a 99 dividend safety score from Simply Safe Dividends, meaning this is the highest score possible, and over the short and medium term, it's very unlikely that we see Procter & Gamble reducing or suspending that dividend to their shareholders. And for all 4 companies we're going to go over today, they all have that 99 dividend safety score, showing that they're considered to be the safest level of dividend income you can find on the market right now, and that really is attractive to many investors who want consistency, growth, and stability within their portfolios. So of course, none of these companies we're going to go over today provide the fastest growth by any means, but these are the slow, boring, and stable companies that may be a nice balance to a lot more volatile people's portfolios that we see on the market right now. So Procter Gamble was the first company that's considered a very safe income producing asset. And if we jump over to my personal portfolio, I do own this company as well. I own 27 shares of PG with a market value around $3,633, and I'm pretty much flat on this position, only up by 2.2%. So this is the first stock we're going to go over today. And now if we jump in to ticker number 2, it is Nextera Energy. The company currently trades for $73 per share and is up by over 14% on the 1-year chart. And if we take a longer term perspective, over the past 5 years, they've grown by 137%, which is absolutely remarkable. They have a current market cap at $141 billion. They are trading with a high forward PE ratio around 29.2 and a current dividend yield of 2%. And this is a large energy/utility company, and they currently operate FPL, which is the largest electric utility company in the United States, as well as they are a world leader in electricity generated from the wind and the sun. So I'm personally a bull on this company because they have exposure to the traditional and renewable energy space, and I think overall renewables will continue to grow for long into the future and become a primary role of the way we collect our energy in our society. And taking a look at the numbers, why the company's share price has exploded over the past few years is because their earnings have been absolutely phenomenal. Their adjusted earnings per share has grown at a CAGR of 8.7% over the past 15 years. So for a boring utility-based company to see this type of growth is absolutely remarkable. And their annual dividend, starting back in 2005, has grown at a CAGR of 9.6% to get to where we are today. A 9.6% annual expansion in the passive income from a boring, stable, utility-based company. And we can see that over the past decade, this company has provided a total return of around 700%, grossly outperforming the S&P 500, which has returned 237% over that same period. So overall, this company has been performing very strong, and Nextera Energy is definitely a brand to take a look at in that utility sector. And going forward, they believe through 2021, 22, and 23, their annual earnings per share will grow between 6 and 8% per year, and they're forecasting that their dividend per share will continue to grow at that 10% rate through this year and next year as well, which is a great sign for your passive income. And taking a look, although the yield starts at a 2% right now, the payout ratio is only 61% of the company's net income, so it is once again sustainable and they have room to grow it going forward, and their 5-year dividend CAGR is at 12.38%. So although the starting yield is a little bit on the low side, it's compounding and growing at a very fast rate year after year. And this is a dividend aristocrat, and for the past 26 years, they've continuously grown their payment. And like I mentioned at Procter Gamble, they have the highest dividend safety score possible, coming in at a 99, so very little risk or uncertainty surrounding the dividend coming soon over the next few years. So Nextera Energy is another I believe to be an overlooked company in the market right now. Of course, their valuation is pretty high at this current point in time with the forward PE of 29, but maybe on any dips going forward, it may make a nice addition to a dividend growth portfolio. And this is a company I do own as well in my personal holdings. And we can see that at this current point in time, my position in NEE is around 40 shares with a market value of just under $3,000. And I'm currently up 10% on this position as of the recording of this video. And we can see on the 52-week chart, they are trading toward the center. So we have seen a pullback away from the $87 52-week high, and if it continues to fall, it may become a very attractive company to take a look at for your own portfolio. And now we're going to continue on into stock number 3 of the companies that are paying out some safe and growing dividend income, and it's going to be ticker JNJ, which is Johnson & Johnson. They currently trade for $164 per share, and the leader of the healthcare sector is up by over 13% on the 1-year chart and currently trade with a market cap at $430 billion. The company now has a forward PE ratio of around 17.5 and a nice current yield of 2.5%. And this healthcare giant generated over $82 billion of revenue in the past year, and that's broken down into 3 different product categories. They have worldwide consumer health sales, some big pharma sales, and medical device sales as well. And the products that Johnson & Johnson sells, similar to Procter Gamble, are always in demand. These different medicines and the medical device products will still be sold year in and year out through good or bad economic periods, which is what makes these companies very safe and very sustainable over the long term. And we can see that this is a brand that's nicely diversified as well. They have 28 different platforms/products that generate over $1 billion in annual revenue, meaning 16 different brands that are included here each bring in $1 billion of annual revenue. And these 12 platforms each bring in over $2 billion of revenue each. So of that 82 plus billion of total sales, it's diversified nicely across many different products. And again, that helps contribute to the safety of their dividend income. If one or two of these brands go down in sales, it's not going to harshly impact the entire company because they have so many different products generating global revenue. And taking a look at their income statement, we can see that similar to Procter & Gamble, even for another beast of a company, their total sales continue to grow year after year. And in the past 5 years, they've gone from around $72 billion of total revenue to over $84 billion in the trailing 12 months. And slow and consistent growth year after year is a very strong sign. And taking a look at the cash flow statement for a dividend company, we love to see growing free cash flow, and Johnson & Johnson is doing just that. From just over $17.7 billion of total free cash flow back in 2017, that number has gone up year after year to over $20.8 billion in the trailing 12 months. And taking a look at the company's dividend scorecard, that yield of 2.5% makes up a very low and very, very sustainable 44% of their net income. So this is a company that has a lot of capital left over to reinvest, grow the business, develop new products. They can also pay down debt and return a growing dividend for many years to come. In their current 5-year dividend CAGR comes in at 6%, and this is a dividend king with 58 consecutive years of dividend growth. And I think something very impressive with Johnson & Johnson is they are one of 2 companies in the world that has a higher credit rating than the US government. Johnson & Johnson and Microsoft are the 2 brands that actually have a higher credit rating than the entire US government. That's so safe and sustainable that creditors believe Johnson & Johnson is, and over the long term, their passive income that is ranked at a 99 will continue to flow into the pockets of their dividend investors for many years to come. So J&J was the 3rd stock we're going to go over in this episode. And now if we fast forward into the 4th and final company we're going to take a look at today, it's going to be ticker AFL, which is Aflac. They currently trade for $56 per share, and over the past 12 months have seen some nice expansion of over 43%. So of course, this is an insurance company that actually has some nice international revenue as well, and a large portion of their sales actually comes from Japan. And we can see they have a current market cap just under $39 billion and are trading to what I believe a very attractive forward PE ratio of only 10.8 and a yield of 2.35%. And we can see that Japan is a major market for this company, and in the past 15 years, the market has more than doubled. So the demand in Japan, even though it's somewhat of a stagnant nation, is growing in the personal and healthcare sector for insurance policies. And taking a look at the numbers, Aflac is another company that returns great capital to their investors year after year. We can see growing tactical deployment every single year, and they do different dividend payments and even share buybacks, which is a great sign. And over the next few years, they believe they're going to return $8 to $9 billion of capital to their investors. And in the first quarter, they returned $650 million through the form of share buybacks. And Aflac is another company with a very strong dividend history. We can see that their last increase was nearly 18% in the first quarter of 2021. So they're not getting the 2 to 4% dividend increases. This company is showing major dividend growth year after year. And since 1983, they continue to grow that payment, which is a very strong sign. And taking a look at the dividend scorecard, that 2.3% starting yield with a payout ratio that is the lowest amongst the 4 companies we've gone over, making up only 25% of their net income in the 5-year CAGR, is at 8.5%. And this is another dividend aristocrat with a 39-year streak of dividend growth and a current dividend safety score, of course, at that 99. So Aflac is probably one of the more interesting companies to be included in this episode. I'm sure you've all heard of the companies like Johnson & Johnson and Procter Gamble before. Nextera might be a new one, and I think Aflac is going to surprise many people because they do provide some nice growing in what looks to be safe dividend income every single quarter. So this was the fourth and final company we're going to take a look at in this episode. Now I'm going to wrap it up. I want to thank you for watching the video to the end. Please hit that like button and subscribe. I'm the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy, and any major market news. So please hit that like button, subscribe for the daily videos, and I will see you in tomorrow's episode.